over a 20-year period, there are roughly only 7% of people that outperform the market. And when I refer to the market, I'm referring to the S&P 500 as the base index fund. Now, if you go down to just a year period of time frame, it's actually closer to 40%. 3 years, closer to 20%. 5 years, still closer to 20%. 10 years, we're down to 10%. 15 years, we're still closer to that 10%. And then we go to 20-year span, roughly only 7% of people outperform the market. One of the biggest pitfalls for not outperforming the market is not sticking to your guns or not having good benchmarks or parameters in which you're investing. We can be very emotional beings that when we see stocks or our accounts plummet, we might be prone to sell off early. We might be prone to make poor financial decisions. So some of the safeguards that I built for myself to try to continue to beat the market is that I only do quarterly reviews. So I only review and change and edit my portfolio about 4 times in a year. I'll review the financials those 4 times a year. And otherwise, regardless of whatever's going on, I consistently add and buy. The ABB, always be buying. Now, if I see that the market's going down, depending on what my budget allows, I will buy more. But I also have a pretty strict rule of what type of companies that I will invest in. And I stick to that, and I don't allow for any bit more than about 3% of my portfolio to be what I would deem as a higher risk. What safeguards do you take in your investing to try to outperform the market regularly? Let me know in the comments below.